The market is falling. Headlines are screaming. Inflation, war, recession, crisis. Your portfolio has gone into the red. It's deep in the red, and you're panicking. You're tempted to sell everything and hide your money under the mattress. First, stop. If you really want to come out stronger out of this, both financially and emotionally, then there are 5 things that you need to understand about market turbulence. Let me show you. The markets are not broken. This is normal. Volatility isn't a bug of the system. It is the system. Stocks fall, sometimes hard, sometimes harder and for longer than we like. In the last 70 years, for example, in the UK alone, the market has had plenty of crashes. The 87 crash, the dot-com burst, the financial crisis, COVID, and that's just the big ones. There have been 10% falls almost every year at some point during the year. And yet in the long term, after all that panic's over, the long-term trend is up. The market keeps rising. If you can stay invested through the dips, then you give yourself the best chance of taking part in the recoveries. And the recoveries don't just get back to where you were, they go far beyond that and keep on climbing. I've said this in other videos and I'm going to say it again. If you're trying to time the bottom, you'll lose. Just forget about doing that. Forget about timing the market. You can't. Yes, you might get lucky a few times, but that's not reality. That's a gamble. That's not investing. It's tempting to think that you'll be able to get out before it gets worse. Or, of course, that you'll be able to jump back in at the bottom. Do you know where the bottom is? Do you know where the bottom will be? Do you think you'll know what it looks like when it eventually gets there? Or, what's more likely is, will you miss the bottom and try and catch it on the way up again? Perhaps even at a higher point than when you're selling now. The data on this is brutal. Most investors who try and time the market end up worse off. Even just missing a few of the best days wipes out the majority of your long-term gains. Just don't bother. I don't, and you shouldn't either. And that's not to say you might not get it right. Sometimes you might be able to time the market. But even a clock that's not working is right twice a day. That means the rest of the time it's wrong, just like you'll probably be. Part of the reason you need to stay in the market and not time recoveries is because it's not just recoveries that matter. Yes, the best days often happen after the worst days in the market, but there's also dividends to take into account. Just because the market is crashing doesn't mean investors don't get paid dividends on the stocks they hold, either directly or through a fund. If you're out of the market, you're losing out on that income as well. We all know that markets move fast. You never get a calendar invite suddenly saying, market recovery next Monday. So just stay invested, stay consistent. Remember, time in the market beats timing the market every time. And here's the third of my 5 points. You're not investing for tomorrow. You're investing for decades. When you zoom out, short-term noise looks tiny. It is tiny. And over the long term, the emotional noise is even tinier. Do you recall how you felt when the dot-com bubble burst, if you were around then? Or do you remember what the financial crisis felt like? Does it feel as strong now? Okay, you might have a better idea of what the pandemic felt like because it's the most recent big crash in living memory. But the others, do they feel as emotionally strong as they did perhaps back then? Probably not. A crash this year may hurt now, but it will barely register 20 years from now. Investing for me is long-term. It's about how I make the most of my money grow for me. It's not my income earner. I earn my income in other ways, through work, through business, through side hustles. So if you're investing for retirement, trying to build up a deposit for a home in a decade or so, or your kid's future, the key is sticking to your plan. Short-term blips are not really going to matter on the long-term trend. Don't let short-term fear ruin a long-term strategy. So when fear hits, check your horizon. How long am I actually investing for? Am I planning on selling everything and realizing that goal I started with in the next 12 months? If not, you're probably okay. Just check your horizon and tell yourself to calm down. Here's the really interesting bit. Rebalancing your portfolio during a crisis can actually be an opportunity. Because when prices are crashing, your portfolio is showing red, but that means that everything's getting cheaper, right? So the stuff you bought, the investments you bought, or whatever they were worth yesterday, last month, last year, they're even cheaper now. So you can buy at rock bottom prices. So let's take an example. Stocks have fallen, so your overall portfolio balance, I'm going to get that word right, I can never say it right on these videos. Your stock portfolio, if stocks are falling, the balance of stocks in your portfolio is lower than it should be. So if you were to take some time out and rebalance, that is maybe selling a little bit of your bonds or using your existing cash that's in your account for topping up your stocks portfolio, then this can actually help you stay aligned with your investment strategy and potentially benefit you when stocks recover. So whilst you're looking at that red in your portfolio, try and turn that into an opportunity instead of just giving into that fear. Don't panic, but rebalance if needed. And the last point I'm going to make in this video video is know your enemy. The enemy here is your emotions, really, if you think about it. It's not really the market crash or something that destroys portfolios. There's that word again. It's people panicking and selling at the wrong possible moment. If the thought of losing money keeps you up at night, it might mean that you're taking on more risk than you're comfortable with. Or it might just mean that your emotions are out of whack. Get them in check. Refer to the 4 points I've just made in this video. Maybe go through the video again. Get your emotions in check. Know your long-term strategy. Take an opportunity to rebalance. And don't try and time things. Just like timing entry is bad, timing exit could also be bad. By all means, check your risk tolerance and adjust your portfolio if needed. But the key is don't just react to headlines. How much will all of this crisis stuff really matter? Maybe in 6 months, in a year, 2 years, 5 years from now, 10 years from now. Market turbulence isn't pleasant. We all know that. And particularly when the market is turbulent going downwards, or at least it feels like it's going downwards. Day after day, week after week perhaps. But year after year? Decade after decade? I know market turbulence isn't pleasant, but it's not unusual either. If you have a sound plan and that plan is still valid, then stick to it. And if you do stick to it, you're ahead of most. Firstly, most people don't invest. Secondly, people don't stick to their investment plans, if they have one at all, in the bad times, or the assumed bad times. Let volatility be your teacher, not your trigger. If you're new to this world of investing, then take a look at this video over here. It's my beginner's guide to investing. Yes, that unpredictable, messy, emotional thing called investing. I'll see you there next.